Investor Intelligence provides general information only. You should consider seeking independent advice to see how this information relates to your unique circumstances. Please refer to the terms and conditions available at investorintelligence.com.au for more.
Welcome to this week's episode of Investor Intelligence, your weekly podcast on all things investment, hosted by me, Jacob Kearns. Navigating the ever-changing lending market is an aspect of growing a portfolio that property investors will know all too well. Joining me once again today is the General Manager at Crown Money Management, Chelsea Burton, to discuss how the lending market has changed over the years, as well as what changes could be coming in the future. Welcome back, Chelsea.
Thanks for having me.
It's always a pleasure to have you on. Before we jump in, can you describe both your roles at Crown Money Management and your also mortgage broking business as well?
Yeah, so I've been with Crown Money for nearly 12 years. I'm the General Manager at Crown, so I do a little bit of everything. I handle the finances, I handle customer service experience, I handle HR, a bit of the operations, a little bit of everything really, and help out wherever it's necessary. And I've been a mortgage broker for about 8 years, helping first home buyers, refinancing clients, and helping investors build property portfolios with structuring their loans right.
Awesome. Crown Money Management is a bit of everything, right? And then your mortgage broking business is also everything. Do you specialize in one or the other or both?
Crown specializes in helping people get out of debt on their house as quickly as possible. So we have our own home loan product that's designed to help people to do that. It helps people budget, better manage their money, and gives them their own personal financial coach to help them to stick to their goal of paying off their house. From a mortgage broking perspective, I specialize in helping investor clients grow their property portfolios, making sure that their loans are structured properly, that they've got adequate cash flow, that they're maintaining good interest rates, and that they know when they can go again.
Yeah. And so 8 years, that's quite a long time.
It's a little while.
Yeah, it is a little while. So how has the market changed in terms of lending and interest rates and everything from when you started your career 8 years ago in mortgage broking specifically versus today's market?
It's been crazy, actually. When I first started at Crown, it was probably a year or so after the GFC really ended. Interest rates were around 7%. So they were quite similar to what they are today, and they basically what they are average in the market. Over history, they're usually around 6 or 7%. But then during COVID, they obviously dropped a lot, and 2% interest rates, 1% interest rates, we've never ever seen those before. I very much doubt we'll ever see them again. The interest rates now are back to where they used to be, and I think they're going to stay roughly where they are for a little while now, hopefully with a few little drops. It's been amazing, actually, because people who bought houses during COVID or just after when the rates were 1% and 2% have often asked me whether or not they're going to go back to normal at some point in the future, and understanding that this is normal where we are now is challenging.
Yeah, it is interesting to have these conversations and to hear people's perspectives, because we got so used to low interest rates and cheap money. And now I remember stories of my great-grandmother who bought with 18% interest rates, and that was just normal, right? Obviously very high repayments on those, but to go down to 1-2% rates is pretty crazy.
It is crazy. And the good news is I don't think we can ever get back to 18% interest rates again.
Well, that's good.
I just don't think anybody could afford to make those repayments anymore.
No, definitely. It's too much debt. So can you explain a little bit about the dynamic between, like, why were rates so low? Why have they been so high previously, and why are they kind of normal now? Like, what affects those changes?
Inflation tends to affect interest rates. So the RBA uses interest rates to ebb and flow spending. So when people are spending a lot of money on consumer products, they tend to raise interest rates to slow that down because cost of living goes up. So if we've got more money to pay on our mortgage, we've got less money to spend on groceries and on general consumer goods. And so it slows down spending and slows down inflation. And then reversely, when things are getting really tight and when people aren't spending and the market is really nervous, they'll lower interest rates to encourage people to spend money and put money back into the economy.
And so what makes you say that you don't think they'll go back down to those COVID levels?
COVID was a very unique time where a lot of people were out of work, businesses were going belly up all over the place. The economy was very scared. People weren't doing things and we couldn't do things. I mean, we couldn't go out, we couldn't go on holidays, we couldn't spend money really other than renovating our house. That is a once in hopefully not more than 100 years event.
Yeah, don't want to do that again.
Not really. And so the interest rates went down to encourage people to spend, to encourage people to continue to support the economy and do things like get Uber Eats so that small businesses could stay afloat and you could buy retail products. And because a lot of people didn't have money beyond JobKeeper and what they were receiving from Centrelink, spending was tight. So lower interest rates really helped support the economy through that time.
Yeah. Has anything else changed over your career in terms of the lending market?
The Royal Commission in 2016, I think, had a huge impact on the way lending worked. Prior to that, lending was easy in terms of documents that you had to submit to a bank and how much assessment they did. Since the Royal Commission, things have gotten a lot tougher. Banks are much more cautious in lending, so they want to make sure that not only does a client say that they can afford the loan, but the bank thinks that they can afford the loan. So they add buffers all over the place. They increase monthly expenses. They increase your interest rates when they do your calculating. They do a forensic accounting on your bank statements to see what you're actually spending and whether or not you've got any debts that you're not reporting. And they take credit cards and personal loans a lot more seriously than they used to. Lending right now is probably the toughest I've ever seen it. Again, it does come and go. So after the GFC, lending was really hard. During COVID, it was really easy. And because banks have targets that they have to hit, and then they've got limits on particularly investment lending and purchasing that they can go to. So if they're getting close to their limits, their interest rates go up and they tend to get less giving with their money. When they've got lots of money to spend, then lending becomes easier and things go through a lot more quickly.
Right. And you mentioned banks have a bit of a buffer in place. Can you explain a bit more about what that is?
So when we do borrowing capacities, the banks don't use actual figures for liabilities or for incomes because they expect that things may change. So when you refinance a loan or purchase a property and you're looking at the interest rate of that loan, if you've got, say, a 6.5% interest rate on your house, the bank will buffer that by 2.5% to 3%. So they'll look at it based on a 8-9% interest rate to determine if interest rates go up, can you still afford to make these payments? If you've got a property that is rented out, they will assume that it's only rented out for 80% of the year. So they're only going to use 80% of your rent.
Interesting.
And then if you get a lot of overtime or bonuses or something with your salary, they don't use the full amount of that as well. They'll only use 60, 70, 80% of it just in case it doesn't happen because you're on annual leave or something.
So the buffer of 2.5% to 3%, that's increased quite recently, I believe?
It used to be, depending on the bank, between 1% and 2% pre-COVID.
Yeah.
Once interest rates dropped, they increased it to 3%. So when interest rates were at 2%, they were increasing it to 3%, which was fair because the chances of interest rates going back to 5% was pretty much absolute.
Yeah.
I'm hoping that in the future they might start decreasing that again and make it less of a hard barrier because I don't think interest rates are going to go up 3% now. Fingers crossed.
Yeah, hopefully.
I think they'll decrease. And I think once interest rates do start to stabilise or start to decrease, they might reduce those buffers. They're certainly doing it now for refinancing.
Okay.
So if you're refinancing, there are options for a 1% to 2% buffer, as long as you're not increasing your debt at all. So if it's a straight refinance, dollar for dollar, and you're dropping your interest rate on what you've previously had and you've been making your repayments on time. But for purchases at the moment, it's still 2.5% to 3%.
Right. And you mentioned earlier that interest rates have gone up because of inflation. Inflation looks like it's going back down. I think we just got quite a good CPI result. Correct me if I'm wrong.
think, it's definitely looking more like where we want it to be.
Yeah, I think it was better than the RBA expected.
Yes.
I could be totally wrong. I recall reading that, but don't quote me. But I do know it's going down, right? And they forecasted, a lot of their forecasts have been by mid next year that they expect inflation to be back down to their targeted 2 to 3%.
Yeah, exactly. And so when we start seeing that, we should see everything start to level out.
Yeah. You mentioned that we're in quite a tight environment for lending. So once interest rates or inflation starts to come down, interest rates will hopefully drop a little bit as well. Do you foresee any other changes coming?
I'm hoping that will mean that the banks will start relaxing their buffers and start accepting more income than what they're currently doing. So being a little bit more lenient with rentals. The banks have a minimum monthly expenditure amount that they will allow depending on your family makeup and income. And so I'm hoping with the reduction in inflation and which will hopefully lead to a reduction in living expenses, the banks will reflect that in their borrowing capacities as well and reduce their minimum monthly expenses.
So it's been hard for everyone to borrow money, but particularly younger people because of lower incomes. What does all this mean for younger people trying to enter the market, whether they're trying to buy their first home or trying to buy an investment?
It's a great question. At the moment, there are a lot of incentives available for young people trying to buy their first home with stamp duty concessions, the first home loan deposit scheme, which removes their requirement to pay mortgage insurance. And if they're building a new house, there's still the first homeowners grant as well.
Yeah.
Whether or not these things are going to continue, it's reviewed every financial year, so there's no way of knowing. The issue with them, though, is that because house prices have gone up so rapidly and they are now so high, the limits on purchase prices to be able to get these benefits have an increase. So potential home buyers, the limit might be $600,000 for buying a house and getting access to all of these things, but the houses in the areas that they want to buy are $1 million or more. So they're not getting access to any of the benefits. So they're having to move further and further out of town in order to get all of these benefits. But it does mean if they can get the grants, they're having to save up a lot less money to be able to get into their first home. Yeah. Which is great.
Definitely.
I think people just need to be aware that potentially they're not going to be able to buy straight off the bat what their parents own. So they might need to buy an apartment or a townhouse, or they might need to live, an extra half an hour out of the city in order to afford their first house.
Yeah, it can be a bit hard, especially when you've grown accustomed to an area. You don't really want to leave your home.
No, but then if you look at, your parents probably didn't live where they live now when they got started.
That's true, yeah.
Yeah, they gradually built it up. And I think there is an expectation from all of us today that we can afford what our parents have and we can't necessarily.
So is there any particular demographic that might find it a little bit more difficult to borrow money?
People who have got nice, consistent, full-time, part-time incomes tend to find it pretty easy. People in essential services tend to find it pretty easy. Those on casual incomes or working as contractors or self-employed are finding it a lot more difficult because banks like consistent incomes. They don't like incomes that fluctuate.
Yeah, no, that makes a lot of sense.
Yeah.
What about older people later in life? Is it difficult after you get to a certain age? Like, what's the cutoff when banks might not want to borrow or lend you as much?
It depends on whether or not you've got an exit strategy. So if you're over 60 and you've got no super, being able to borrow for a home is going to be almost impossible.
Right.
If you're buying an investment property and you own your own home, you'll probably be fine.
Okay.
Because they want to know that when you retire at 67, you have a way of either continuing to pay your mortgage or being debt-free on your house so that you've got the ability to sell anything and continue living not on the pension. So if you own your house and you want to buy an investment property, you'll probably be fine. If you're renting and you want to buy an investment property and you don't have any super or a business to sell or any assets to sell, you are going to run into problems and it is unlikely that you'll be able to borrow for that investment property. Between 50 and 60, they're still looking for an exit strategy, but they're a little bit more lenient. So they want to know that you have the ability to have a home that's debt-free by 67, but the ways that you can do that are a little bit more lenient.
Okay.
Between 40 and 50, where you've got still almost 30 years to pay off the loan, as long as you can say how you're going to pay it off by the time you get to 67, you don't really have to prove anything.
Okay.
But banks are asking for superannuation statements to prove your exit strategy if you're going to use super, or they will ask possibly for valuations on existing properties if the exit strategy is to sell investment properties to pay off your house.
So if someone was in their, let's say, early 50s, what should they be doing to, if they want to sort of get a couple of properties before retirement, what should they be thinking about or doing?
They need to make sure that they have an exit strategy. So they need to have their house paid off, or they need to be moving in such a way that by the time they get to age 67, that house is going to be paid off and debt-free. So whether that be putting more focus on paying off the loan, maybe not refinancing it so that your amortization period expires before you turn 67, or having a reduced overall loan term so that you can have it paid off before you get to 67. The goal is to make sure that that house is debt-free completely, so that any investment properties that you buy, it doesn't really matter, because as the debt on the investment property is going to be cheaper than the investment property value, so you can always sell it to pay off debt. But having your house debt-free is going to be key.
And how does that differ between someone maybe in the early 40s?
It is. Someone in their early 40s has a lot of opportunity to pay off their debt, because if let's say you're 42, you've still got 25 years to 67.
Yeah.
Right? So even if you start a brand new loan today, 67 is only just shy of 30 years. So as long as you've got a little bit of an asset position, you've got a little bit of super that you could potentially use, or the option to downsize your home, you don't really have to prove anything. You just need to be able to explain what your thinking is.
Right.
So, under 50, it's much simpler.
Yeah. Okay. So it's really sort of the 50s where it starts to get a bit complicated.
Yeah, correct.
Okay. Going back to the topic of interest rates before, over the next sort of 12 to 24 months, I'm not sure if you want to predict anything, or how do you kind of see that playing out once inflation comes down?
It's a great question. The major banks are sort of suggesting that somewhere between September this year and March next year, interest rates will start to drop, and they're thinking maybe about 1%. I'm crossing my fingers that that's true. You can see from the current fixed rates that the 2 and 3 year fixed rates are starting to be slightly cheaper than the variables, which means that the banks do think that the rates will come down. I think they're probably going to come down 1%. I think it'll happen over 12 months. So by November next year, we might be 1% lower than we are today. I don't think they're going to go up anymore.
And then what does 1 basis point, so 0.25%, what does that do for your borrowing capacity?
It will increase it by about, depending on your income, about 30 to 40,000 per 0.25%. So it could increase it by 100 grand.
Well, that definitely opens up a lot for a lot of people.
Yeah, absolutely. It's going to make life much easier.
And then do you forecast, or are you thinking with that buffer as well? I know you mentioned you're hoping that will come down as well. How likely do you think that is in the next sort of 12 to 24 months?
I think it's pretty likely. Once the interest rates start dropping, I think it's pretty likely.
And then so that will obviously open up your borrowing capacity quite a bit as well.
Yeah, exactly. So if you can get 1% off on actual interest rates and a reduction of 1% on the buffer rate, then you're going to open your borrowing capacity up by maybe 200 grand.
Yeah, wow. That's really good, actually. So you mentioned house prices are obviously very, very high at the moment, and they've still been increasing despite the high interest rates that we've had. What do you forecast happens once, let's say we do get that extra % drop, and then let's say we do get that buffer drop as well? What do you think happens to house prices then?
I think they're going to go nuts. I think house prices will increase quite significantly once that starts happening. I mean, they're already increasing. People are already excited in the market on the prospect that it might happen. So once it actually does start to come down, and assuming inflation is the cause of them coming down, so inflation is stabilised, people have a good understanding of what their ongoing living expenses are going to be now, I think house prices are going to go crazy.
Yeah, wow. Is there anything that might stop this from happening?
COVID?
COVID too. No, don't even say that.
No, don't even. We have a big shortage at the moment in property in the market because for a variety of reasons, but we've got pretty good immigration. We've got a lot of people entering the country. We have a lot of people who are turning 18 or 20 and moving out of home. We have a lot of people who are currently renting and want to buy homes. And a big problem that we've had is that we have a lot of people who are building homes and haven't been able to move into them, some of them for several years, because the build hasn't been completed because the builder's gone bankrupt. And so as a result of that, we have a huge shortage right now because there are claims sitting with the insurance companies for the builders that haven't been paid out, and houses basically abandoned because no one can finish them until the insurance claim is complete. And so those people who are supposed to be living in those houses are currently renting, or they're currently living in another house that isn't being rented out or isn't being sold because they can't move. And there are several thousand houses in this situation at the moment. So I think if that problem resolves itself and those houses can start being built and those people can start moving, I think it'll take a lot of pressure off the current housing market, and that will stabilise property prices a little bit. But there are also a lot of people renting who do eventually want to buy but can't currently afford to buy because they haven't got the savings or they haven't got the borrowing capacity, and more relaxed borrowing will certainly help that situation and enable them to buy. So I think, property prices are going to keep moving forward.
And how long, with the housing supply issue, how long do you think that takes to sort of rectify itself?
It's a great question, and I think it's really going to depend on how long it takes those insurance companies to finish these properties. And like I said, some of them have been sitting there for 2 or 3 years, so it's not necessarily a speedy process. And you need other builders who can take them over and finish them. A lot of them, especially the ones who have been sitting abandoned for 2 or 3 years, like they've been destroyed by squatters and vandals during that period. There's a requirement in a lot of these cases to start again. So I think it's going to be a little while before that can be rectified.
Yeah, it certainly doesn't sound like a quick fix.
No.
Final questions for you, Chelsea. This has been really interesting, but in terms of the lending market, what changes around like AI? Does that come into this in any way?
I am really excited to see what AI holds for the lending market. I think there is always going to be a place for, mortgage brokers in the market because there are always people who have got complicated situations. I think AI is going to be support for mortgage brokers and support for banks, enabling them to get things done more quickly. But there are so many nuances involved in people's finances, and everybody's situation is different, that I don't think, at least not in the near future, that AI is going to be able to do the job on its own. But it will certainly be able to do things like look at your bank statements and determine what your expenses are. Make it easier for a broker or a bank to fact find information from a client, because it'll be able to review your whole financial history with you just putting in a few details. And so there'll be a lot less input required from a client. They'll just need to check the information rather than input all this information. So I think it's going to have huge potential in terms of making finances easier, but I don't think it's going to, I think it'll eventually revolutionize the industry, just not quite yet.
Yeah, it sounds like that sounds quite similar to a lot of industries as well, making the process a lot simpler.
Yeah, I think AI is a great support. It's a really good way of being more efficient and getting things done more quickly. But in a lot of cases, it's not a total replacement.
And what about any changes to self-managed super fund lending?
I don't think we're going to see any changes in self-managed super fund lending in the short term. I don't see that any of the major banks are going to take it up again. So I think it'll still be always the smaller lenders that do it. I don't think that interest rates will change. I don't really see that there's going to be a lot of change in that area at all.
Thanks, Chelsea. This has been a really interesting conversation, and I'm certainly really interested to see how this all plays out. But to summarize, if someone has been putting off their investing because of interest rates being too high, what would your advice to them be?
There is some good advice out there that says that the best time to buy an investment property was 10 years ago and the next best time is now. And I completely agree with that. House prices in Australia go up. I mean, unless you're buying in a single industry town that is overinflated because of excitement, in general, property prices in Australia go up. So delaying a purchase just means that you're going to pay more for it later. Yeah,
that's interesting. And is that increase in repayments going to be worth the wait? Probably not.
No, exactly. And you'll have to save up more money for the deposit on the same property. Yeah, I think if you are wanting to buy, there's no point in waiting to see what happens with interest rates or what happens with the market, because the second interest rates start going down, property prices are going up.
Awesome. Well, this has been amazing, Chelsea. Thanks so much for coming back on.
My pleasure. Thank you for having me.
No worries. We'll have to get you back on again.
Sounds great.
Awesome.
If you found this episode or any of our episodes helpful, please make sure to share and leave a rating to help us reach more people on their investing journeys. And of course, subscribe to be notified when new episodes drop. Make sure to follow the podcast on Instagram at Investor Intelligence Podcast. You can find links to our other socials in the show notes, including a link to the Property Mentors weekly blog. If you're ready to get your property portfolio in shape for financial freedom, check out Luke's latest book, Property Fit. You can get yourself a copy at www.propertyfitbook.com.au.